All right, we will get started. Welcome to Lockheed Martin Retirement Maximization. My name is Josh Strittmatter.
Hi, and I'm Kelly Boofing.
And we are with Strittmatter Wealth. We're so glad you're here today. This is how to not miss out on what you are entitled to and get every last penny you can get before your retirement countdown clock.
And you know you have one.
Shows zero. So before we get going, go ahead, Kelly. Just to give some quick disclaimers, today's information is purely educational. It's not meant as tax or legal advice, so be sure and talk to a licensed professional before taking any action. Next. And we are Strittmatter Wealth Management Group. We are a registered investment advisor since 2007. We're certified financial planners and fiduciaries for our clients. We specialize in retirement planning, investment management, estate planning, and real estate investing. We work with a lot of Lockheed employees, and that's why we do these presentations. We just have, because we're in Fort Worth, we've naturally worked with many Lockheed employees over the years, and I've and Kelly have both enjoyed working with them. So we have built out an entire planning area specifically for Lockheed employees. And so that's who we are. And there's some great pictures of us. Both Kelly and I are on the call today. We'll be presenting to you today. We're both certified financial planners, both been in the industry for over 20 years. Mm-hmm. And you can read more about us on our website, strittmatterwealth.com. All right.
Yes. And today we're going to be going over a number of things. We have 6 important areas that we're going to cover. First, we're going to talk about the changes that happen with Lockheed with 401ks and pensions. We'll talk about the pension and how it works and specific strategies that you guys can use. We'll also talk about the ins and outs of your 401k and some strategies for it as well. We will also talk about your healthcare options upon retirement. There are many things that some people don't even realize when you retire about your healthcare, so I think that'll be very important for you. We'll talk about your other investment benefits and what you can also take with you into retirement. And then we'll review the list of the top 10 mistakes to avoid, and finally, we'll wrap it up. So then let's begin with Lockheed Martin retirement changes. And all of you are very well aware now that the changes happened to your pension plan started way back in 2006. And that's when the pension was closed to any new employees starting in January of 2006, if I can get the right year. And then all of your pay elements under that plan were frozen on December 31st of 2015. So your credited service accruals were frozen as of December 2019. So not too many years ago. And then on January 1st of 2020, that's when Lockheed started putting the 6% into your salaried savings plan as an automatic contribution for every single employee. So we know this was quite a change for some people who had been at Lockheed for a number of years, and it does affect how your pension works going forward. And for newer employees who don't have a pension, it makes it even more important to know what you need to do to be able to retire successfully. So first off, let's talk about what is a pension. Josh, what's a pension?
A pension, also known as a defined benefit plan, provides a specified monthly benefit at retirement to eligible employees. Usually has a vesting schedule.
Yep. Another way to say it, guaranteed income. Now, you guys have a defined contribution plan and there is a defined benefit plan. So Josh, what's the difference between those two?
Well, a defined contribution plan is like your 401k. It allows you to put in contributions each payroll period. And you have control over how much money you're putting into up to the IRS maximum. Your benefits for your defined contribution plan are based on how much money you save, the performance of your investments, how much your employer has put into it, and the expenses of the investments. So your performance may vary depending on how you manage it. You also get an individual account for each person that contributes to it. Your employer may contribute to it, and Lockheed does contribute to yours as well. They provide a match. You typically elect a percentage of your pay that you contribute to it. And that goes directly in through payroll deduct. You're responsible for making your investment choices, so your investment results will depend upon how well you choose your investments. And then when you pull money out, the money is taxable based on how you saved to it. So if you save pre-tax to your 401k, you'll pay tax on the earnings and the growth of it when you begin to pull it out, and the principal, I should say, when you pull it out. If you save post-tax, you would have already paid tax on the principal, but it's the growth of it that you would pay tax on it if you save post-tax. But most people save to the Roth portion of the 401k now, which means the earnings would be tax-free. So you wouldn't pay any tax when you pull the money out. And you do have to start taking money out of your plan at age 73, unless you continue to work past age 73, and they allow an exception to that rule when you're continuing to work. Compare that to your defined benefit plan. That plan provides a monthly payout to you once you've retired. It's based on a calculation that looks at different things like service, so total years that you've worked, Social Security breakpoint, which is looking at the Social Security wage base calculation, and then average income and accrual rate. You are not required to make contributions. At Lockheed, your employer is making your contributions. They choose all the investments, and then the amount that you receive is calculated using your calculator to determine the amount that you'll receive, and that amount is guaranteed. So you have different options for how you choose your payout. We'll talk more about that. But here again, you still are subject to the mandatory payout age of 73.
Yes. And with any defined benefit plan or any plan, there are advantages and disadvantages. So let's go over those. So advantages of the defined benefit plan or pension plan is, first off, Lockheed Martin itself is responsible for providing you that benefit. So it's on them, not on you. Second, you'll know the benefit amount in advance. You can actually request that online at different periods if you think you want to retire at 62 or 65 or 72 or whatever age, and you can know what those would look like. The pension doesn't depend on your availability to save to it. There's no investment risk to you. The assets under the pension plan are managed by professional money managers, and there is tax-deferred retirement savings. So that is definitely helpful. Some pension plans, now Lockheed's does not, but some of them offer cost of living adjustments where the income will increase throughout the years to help keep up with inflation. But since the Lockheed pension does not need to do that, that's why we have to be smart in other areas to make sure investments will provide that additional money. Pensions are insured. The PBGC is an insurance company for pension plans, which guarantees most, if not all, earned benefits that an employer cannot pay can be paid. I don't fear Lockheed going out of business, so I think we're okay there. Now, on the flip side, there's always disadvantages, right? Where there's an advantage, you have to have a disadvantage. So first and foremost, you do not have an individual account in a pension plan. Okay? It may provide only a portion of the funds that you need for retirement, and your investments may need to pick up the rest. Sometimes a pension plan can be difficult for employees to understand due to a complex formula on how they calculate what the benefits actually are. And it usually doesn't benefit people who leave a company before retirement if there is a retirement plan in place, because then either their benefit could be reduced or there might be nothing to take with them. I would compare that to military service members. If they were working and stayed active duty for 12 years, they only had 8 more to go to retirement and they left, they wouldn't have a pension. They had to stay their full 20 years. I know that. My husband's retired military. Of course, your benefits also are not typically payable until your normal retirement age, and there is a specific age for each person. And most plans do not permit a lump sum payment at retirement, meaning in forfeiting a monthly income stream for a lump sum chunk of money that you could do whatever you want with. So let's move on and talk about how the pension is calculated. So the pension is calculated based on 4 different factors. The first one is your final average pay. The second is the Social Security breakpoint amount, which we'll go into. The third is your plan accrual rate, and the fourth is your credited years of service. So when we're talking about your final average pay, Lockheed's pension uses the final pay of your highest 3 years during your last 10 years, starting in 2015 and back. Okay, so they look at this portion of your plan because that's when it was frozen. Now, those 3 years do not have to be in consecutive order. You'll see on the example here, in this sample, the year 2011, 2014, and 2015 were the highest 3 years. So you would take those 3, add them together, get the total of 203,000, and then divide by 3. That gives you your average pay of 67,666. Now, Josh, why is the Social Security breakpoint important, and what the heck is this?
Great question, Kelly. So the Social Security breakpoint is the average of your Social Security maximum wage basis. Maximum wage base for Social Security folks is what's used to determine the cap amount of Social Security tax that you pay in your income. And it indexes every year. It's usually reported on the Social Security website. This year, I think it's around, let me see, I've got it right here, I think. I'll tell you what, Kelly, why don't you look that up for me if you can while I'm continuing to explain this, but I think it's around
68,600.
Perfect, 168,000. That's the maximum amount of income that you pay Social Security tax on. After that amount, you no longer pay Social Security tax. So this looks back at your average maximum wage base over the course of your life, and it uses that in the calculation to apply the percentages that calculate your total bonus. And we'll see that in the example in just a minute.
Now, the accrual rate is the factor that's applied to your final average pay, and it's used to determine your actual benefit. So Lockheed Martin has a tiered calculation formula. So for the first section, your final average pay up to the Social Security breakpoint is multiplied by 1.25%. Then times your credited service up to 35 years. Okay, so once you have that number, then you add that to the next level, which is your final average pay over that Social Security breakpoint times 1.5%, then times your credited service up to 35 years. And then you add that amount to the third and final level, which is your final average pay times 1.5% times any credited service over 35 years. So we have an example for you. Josh, you want to run through this?
Yep, absolutely. So this shows you this employee's final average pay. So again, the top 3 years before December 31st of 2015 was 125,000. The Social Security breakpoint for that year, for the average for that person's lifespan, was 99,720. So there's an accrual percentage for below that breakpoint and an accrual percentage for above that breakpoint. So up to the 99,720, it's 1.25%. So you multiply that against the total average pay of 125,000. That's 1,247. Then you have the accrual above that amount, and that's a very small amount, so $379. You look at the years of credited service through 2019 when it was frozen, and that's 20 for this particular person. And so you add up those figures, you multiply it by 20, and that gives you the annual figure for the pension amount. And this is the life-only payout. So this is if you take it only on your life with no beneficiary. You divide that by 12, and it gives you the monthly figure. So that is how that's the backdoor math calculating your single life or life-only pension payout from Lockheed.
And the easiest way to do it, y'all, ask for the report. Then you don't have to worry about the math. But it's important to know the math so you can check it and make sure it's right.
Absolutely.
And Josh, I'm glad you mentioned that single life only, because when Lockheed employees take their pension, they have options on how to receive it. And this is important if you are married. If you are single and not married, single life means that pension will pay out until you die. It doesn't go to anybody else. But if you are someone who's married, you need to think about your spouse. If you die before they do, how do you want your pension to continue? If you're married and you select single life only, then it stops and your spouse gets nothing. Or you have various options, which are on the screen. So the first one is joint and survivor at 100%. And what that means is that if you start your pension, you elect this option, your pension amount will be a little bit less so that when you pass away first, your spouse will continue to receive that pension exactly the same, no changes. They get the same amount of money. Okay, so it pays out over 2 lives. The joint and survivor 50% option means that your spouse, your survivor, would receive half of what you were getting when you were alive. Okay, so if you get $4,000 a month, you die, they get $2,000 a month. Now there is a special pop-up provision. What that pop-up provision means that if you did elect a survivor benefit and your spouse died within 5 years of retirement, your pension would automatically go back up to that full single life only. Okay, there's no reason to keep a reduced payment for the rest of your life when there's no survivor anymore. So that's a fantastic thing that Lockheed did for a lot of employees whose spouses actually passed away before they did. So.
Those are your different options.
Yes,
They
sir.
have other options, Kelly, as you know. They have the joint 75%. They also have one that includes taking into account Social Security. So there's lots of different options to choose from. Those are the main options to choose from.
Right. And when you get your report, all of those are actually listed on that report. Now, before you actually make that decision though, and go do your paperwork and retire, you should really look at all of your distribution options. Make sure you know exactly how that will affect you going forward, because once you make that election, you can't go back and change it. Okay. And when you are purchasing a survivor option through that pension and you're electing that option, you're basically purchasing a life insurance policy from your pension plan, because when you die, they're guaranteeing that that pension income is going to continue to go to your survivor. Now, the risk with the joint and survivor option is that if the survivor dies before you after year number 6, because that pop-up provision is no longer there. So an alternate strategy to consider is to purchase your own life insurance policy, which may often lead to better rates and benefits and enhance your pension annuity option that you elect. So let's talk about this strategy a little bit so you can see how you can maximize your pension benefits. So it's called pension maximization. And we're going to look at this example of Bob and Julia. So Bob is considering either electing the single life option for his pension or the joint and 100% survivor option. And as you can see, the single life monthly benefit amount is $2,874, whereas the joint and survivor 100% survivor option is $2,010 per month. And of course, remember, that's reduced because you elected the survivor benefit, so it's paying out over 2 lives instead of 1. And that's an $865 a month difference that you don't receive, but rather you are paying for that life insurance through the pension to guarantee that income to your survivor. So here's how it works. If Bob wanted to do pension maximization for Julia, Bob would choose the single life option benefit and then use that extra $865, that was the difference between the two, to purchase his own personal life insurance policy. Now, if the policy costs less than $865, then they've increased their monthly benefit while Bob is alive. In addition, the policy provides a death benefit more than $2,010 per month for Julia after Bob dies. Then they've come out ahead. So what Bob and Julia are actually looking for is a policy that costs less than $865 a month and provides more than $2,010 a month. But let me ask you this. What happens if Julia dies first? Josh, does Bob have options?
Well, he does now.
He does
Because
now.
if Julia dies first under his old pension plan, or just taking the payment, the joint survivor payout, Lockheed has a 5-year pop-up, which means it would go back to the single life payout, the higher amount. But after the 5 years, that goes away. So if his spouse passed away after that 5-year period, he's stuck at that lower payout. With this strategy, because it doesn't matter when, in this case, Julia passes away, all he does now is he just cancels the life insurance because he no longer needs it. And he's already taking the single life payout. He didn't choose a joint payout. He chose a single life payout with life insurance that would pay out to Julia upon his death. Well, if she dies first, he just cancels the life insurance. And now he's got the single life payout for the rest of his life.
Yep. Or he could even keep the insurance if he wanted. He could have access to the cash value. He could pass it on to his heirs. If he's invested well and we're managing his assets well, then we can use it for estate planning purposes as well. So there's all sorts of things you can do with it.
Yep, it provides more options and more flexibility. And that's why people like this strategy, is because it gives you more options.
So let's take a look and see, what do they actually need to consider? And I'm going to tell everybody, just a warning right here. It is important to look before you leap, because if Bob actually decided to use this strategy and he made his pension election before he put any life insurance in place, something drastic could happen, right? He could die. He could have health issues. He could not be able to have the policy. So first, they need to find out if you qualify for the policy based on health and the cost of the policy. You should look at that. Buy the policy first. Make sure it's put in place. Make sure it's enforced. Premiums are paid, so you're good to go. Then make your pension. Because if he is not insurable and can't get the insurance, and he already made that pension decision, he is now stuck. He can't go back. So, like the old saying goes, Julia's going to be up a creek without a paddle. And we have some numbers to give you an idea of what this looks like. So here's the example of Bob and Julia. So when they are talking to their advisor, they know what they can look for. So you need to know, of course, your current age. At what age do you want to retire? And life expectancy is important. How long do you think you're going to live? You know, Josh, we talk to clients every day and their life expectancy is all over the board. And that's based on what things have you heard? Why?
Family, their individual lifestyle, disease in their family and for them. So yeah, and then just also what they read in the news. So just is different for everybody in terms of what their opinion is of it.
Mm-hmm. Okay. And then the other numbers in the middle are how much the pension is at single life and at the 100% joint survivor. The pension is not indexed for COLA, meaning there is no inflation protection on it. When you start it, it stays the same. We already talked about the cost. The lump sum required at death, we actually have a software. We run this, so we know exactly how much you would need as a lump sum to replace that. And then how much would you need if you actually lived to your life expectancy at age 89? And then calculate the value of those savings and find where's that break-even age. So for Bob and Julia, it was age 65. And what that software kicks out for us when we plug in all the numbers and we do the analysis, it gives us all these lovely figures on the board. And in the fourth column to the right, where it says lump sum required to replace pension, we see that $322,171. That's if Bob dies today, that's how much insurance he would need to be able to replace it. But if he's not going to die today, right? Well, we don't want anybody to die today, but if he dies in 20 years at age 80, then he only needs $195,408. And at 89, he would need that $45,000. And that number reduces because as Bob gets closer and closer and closer to his life expectancy, we have a less number of years to replace the income. So by using these figures, you can really put a good pension maximization strategy in place to buy his own life insurance. So the type of life insurance you need to do this is varied. Depends on the strategy. So there's a couple ways to put this in place. The first way is by using the cash value or permanent life insurance. It's permanent because it's designed to last your whole entire lifetime until you die or until you cancel it. So this is recommended because insurance will not expire prior to your death. Now, a term policy by itself is not a good solution because term policies are limited by their term, the number of years, and those typically do expire prior to death. So a second strategy is to use a combination of the two. That way you can pay less in overall premiums, but still have the coverage that you need. Josh, why don't you tell them about the term insurance and permanent and how that works?
Yeah, so we have a unique strategy that we use, and the whole idea here is to keep the cost of insurance lower. So to do so, we do a combination of term insurance and permanent insurance. And so what we look at is a 20-year term life insurance policy. And then what we're looking at is the death benefit need in the 20th year. And so essentially you're defining the total need, and in the 20th year, you're subtracting that out, and that's the net need. In this case, it's 322,000, and then 121,000 is year after the 20th year. So let's see.
Mm-hmm.
Yep, is after the 20th year. So you buy a term policy for just over 200,000, and then you buy a permanent life insurance policy for 122,000 roughly. And the idea here is that term insurance is much less expensive than permanent insurance. So permanent insurance has a cash value component to it. So the amount of money that you have to pay into it monthly is much higher than term insurance. So we're trying to minimize the amount of outflow for insurance here. So the term life gives us a low cost strategy, and then the permanent takes you the rest of the way through the rest of your life, but you're using a lower death benefit. So the combination of these two provides a more easily attainable way of achieving our goal of the premium being lower than the difference between the two pension amounts. So back to this example here. If we did a permanent only plan, the total cost of it would be $3,198. But if we used a term policy, that's $1,144 per year. And then if we used the permanent insurance for 121,000, that's $1,389 per year. So those combined is $2,533. So the savings over doing that term and perm combo is $665 per year. So that's $3,198. That's the cost of the total permanent policy strategy compared to or subtracted from the dual policy, the term and perm policy. And again, that's $665 per year.
Mm-hmm.
So that's below our amount that we were trying to target. So the $865. And therefore this strategy wins. And the net result is that we can obtain $7,847 per year or $654 per month in additional pension payout to me. So that's nothing to throw to the side, folks. That's a lot of money that you'd be paid out over the course of your life. So this strategy is very effective, but I would say it depends upon your insurability. So it makes a lot of sense to do this when you're younger rather than waiting till you're older, because you're much more likely to be insurable.
Yeah, but it is never too late to try. That is for sure. And
True.
Each person's circumstance is very different and what's important to the family and the spouse. So definitely something to talk about. And that's something we sit down with every single person and go over. I know we'll ask questions at the end. We'll love to take your questions. So write them down if you have questions now, because we're about to switch gears and you might forget. So make sure you jot them down. Okay. So let's switch gears and talk about the 401k savings plan and retirement health care. So starting with your 401k savings plan. So Lockheed actually matches 50% of your first 8% contribution. So if anything, you want to be contributing at least 8%, so you're not leaving any free money on the table, okay? Now, every year, the IRS has a rule of how much you can contribute into your 401k. So for 2024, it's $23,000 if you are under age 50. If you are over age 50, you can put in an extra $7,500, which is considered a catch-up contribution. Now you have the option to contribute to either your pre-tax, post-tax, or Roth portion of your 401k. Okay. Now here's an important legal thing to know. In the Secure Act 2.2, any catch-up contributions that are going into your 401k will be required to be invested in the post-tax Roth portion of your 401k if your wages are over $145,000. Now that wage amount will be indexed for inflation, okay? So starting, what are we in, 24? So in 2026, you've got just a little bit more time because a lot of companies don't have a Roth portion, so they have to get this going themselves. Okay. But you can go ahead and start taking advantage of that anytime you want by changing where your contributions are going when you log into Empower. Now, for your 401k, like we said, the first 8% of the 50% is matched. So if you're only doing 6%, you're only getting 3% match. If you're only doing 4%, you're only getting the 2% match. So make sure you're doing at least the 8% if you want full matching benefits. Now, Lockheed is special in the fact that they allow you to actually contribute more than the IRS annual maximum to your 401k. You can actually contribute up to 40% of your base pay. Now, the rule is that that maximum is the lesser of 100% of your compensation, or 66,000 if you're under age 50, or 73,500 if you're over age 50 for this 2024 year. So this is really great for you because it allows you to invest more money into your 401k other than that IRS over age 50 limit of 30,500. I think that's exciting.
That is exciting, Kelly, because I don't know of any other company that allows you to do that, where you can save so much to your 401k and get that tax benefit. It's a lot of money that you can save to that.
Mm-hmm. And the other place people aren't using a lot is your post-tax contributions or your Roth 401k. And what they don't know, Josh, is that once they're 59 and a half, they can actually do an in-service rollover. So even if you're still working, as long as you're over 59 and a half, they can take the money out of the 401k, roll it into their post-tax dollars to a Roth IRA and their pre-tax dollars to a traditional IRA. And when they roll this, they'll actually get 2 checks in the mail, one for pre-tax money, one for post-tax money, because they're 2 different buckets. And then when they have that Roth IRA, their tax-free growth benefits continue and begin, and that 5-year clock happens.
Yeah, so that's a relatively, it's I guess it's probably 10 years old now or more, but that rule is important because you get that post-tax, assuming you save post-tax into your 401k, you'll get that second check. And some people just assume to roll that into their traditional IRA, the pre-tax bucket, when they can roll it to the Roth IRA, which provides great tax benefits to you.
Mm-hmm. Now, hey, Josh, tell them about beneficiaries on their account, because that's very important, and we've seen messes with this in the past.
Absolutely. This is the big deal, folks. So with your 401k, a 401k is considered what's called a direct transfer asset. And what that means is that when you name a beneficiary at your death, whomever you have named as your beneficiary will directly inherit that asset outside of probate. So all they have to do is provide a death certificate. And when they provide that death certificate, the account would be put into their name, and there's nothing else that they would need to do. The problems occur when you don't name a beneficiary in your 401k. And when that happens, that means your 401k has to be probated. And that means hiring an attorney and having to go through the court process to get access to that money. So many people believe that they have a beneficiary and we often find that they don't. So what I recommend that you do is double check, even if you think you do, and print the screen so that you have it for your records. So sometimes what can happen is the 401k company, your 401k company has changed providers. Into Empower is your current provider, but it's changed a couple of times since I've been doing this job. And so something can get messed up there. And you want to make sure you add that beneficiary when it changes providers. So takeaway here is, folks, is make sure you have your beneficiary on file, and that you've got proof that you have it on file, so that you can avoid the headache of having to probate the 401k.
Yes, and one other big mess I have seen over my 20+ years of doing this, and I know you have too, Josh, is when people get divorced, they forget to change their beneficiary,
Yes.
and then they get remarried and die, and the new spouse is not the beneficiary on the 401k. The ex-spouse gets the whole thing, and there is nothing they can do about it.
Yeah.
So, yes, please go check your beneficiaries. Okay, let's talk about stock, because usually a lot of people have a lot of Lockheed Martin stock in their 401k. What should they do with that?
So Kelly, with company stock in a 401k, and this directly looks at retirement. So what do you do with the company stock in a 401k? Well, you can keep it in the 401k and it continues to grow tax-free. But there's a tax strategy that you can use to help reduce the tax burden depending on your tax bracket that you're in. And so it's called net unrealized appreciation. Net unrealized appreciation looks at the taxation of the stock when you take it out of the 401k and roll it into an IRA. You roll it into an IRA, it continues to grow tax deferred. But this strategy looks at actually taking it out of the deferred status altogether and rolling it to what's called a non-qualified account. A non-qualified account is just a taxable account. And what you actually do is you pay tax on that distribution, but you're paying tax just on your basis. So not on the total gain of that stock. And the benefit of that is that you can pay tax at a much lower tax rate because you're paying capital gains tax rates, depending again upon your tax bracket. So it's the difference of paying ordinary income tax versus long-term capital gains tax rates on the growth of the overall stock that you've achieved. The basis is taxed at your ordinary tax rates, but the long-term capital gains tax rate is on the gain. So without getting too far into the weeds here, folks, the easiest thing to do is to do a calculation on this. We have software that we use to help determine if it's in your best interest. But for some clients, it saved them thousands of dollars in taxes by utilizing this strategy. So it makes a lot of sense if you have stock in your 401k to do the net unrealized appreciation calculation.
Oh, geez, I don't know about you, but taxes is not the funnest thing for me to talk about. So I'm going to switch gears and we're going to talk about healthcare. Okay, let's talk about healthcare. This is important because Lockheed Martin has a wonderful retiree medical insurance plan that some employees can actually be eligible for after retirement. And so enrollment may begin either at retirement or when the pension benefit begins. And because the coverage may be different than the current coverage that they have, everybody needs to check with the service center for details. And then the service center also provides quotes for that retiree coverage. Now, the biggest thing about healthcare is when everybody turns the magical age of what age?
59 and a half.
65. No, wrong.
Oh.
65. So 65 is important because that's when Medicare kicks in. If you are retired, you will start Medicare at 65. If you are still working, you are not required to sign up for Medicare. Okay, big important thing to know. So don't mess up the Medicare. But if you are starting Medicare at 65, Lockheed actually has supplement programs that are there for you through the VIA benefits page. So you become eligible at 65 for Medicare. You typically start shopping for supplemental policies and enrolling for these policies about 3 months prior to age 65. Okay, don't do it too far out, but don't do it too close. So 3 months is your magic window. Now, Lockheed even has a subsidy to help offset some of the cost. But you do need to be enrolled in both Part A and Part B. So if you're fully retired, that's totally fine. Lockheed will give you a little bit of money to help pay the premiums. Now, if you have TRICARE for life, so if you're a military retiree, you can add TRICARE on there. So that becomes your supplement. And you have to go through via benefits to be able to get that extra stipend from Lockheed, okay, to get that subsidy. Now, when you are also doing your health care, as we get older, we naturally have some expenses come up. So Lockheed has another account that you can have if you are on a high deductible health insurance plan called a health savings account. Josh, tell them about a health savings account.
Absolutely. This is a fantastic tool, folks. It's one of the few accounts that you can actually save to that you don't pay any tax on the money, both the principal and the growth. So the key thing to remember with this is that you have to be eligible for this. Not everybody is eligible for this. And what makes you eligible is that you're participating in a high deductible health insurance plan as defined by the IRS. Now, the easy way to know is if you're eligible is just to ask your HR department, is this an HSA eligible plan? Most of the plans say HSA eligible next to them in their description. So that also is helpful to help you to know. But the benefit of this is that you can save dollars pre-tax, and through Lockheed, you can actually do it through payroll. So you save dollars pre-tax, and the real benefit of this is that when you pull the money out, when you use it for medical expenses, you don't ever pay tax on the money. The other cool thing about this is that because you do it through Lockheed, you also don't pay FICA taxes, because you can save to an HSA on your own, but when you save on your own, you obviously, it has nothing to do with your payroll. But because you do it through the payroll, you don't pay the FICA taxes. So that's an additional 7.65% on your side. And then whatever tax rate that you don't pay taxes on. The other neat thing about the HSA is once you reach the age of 65, you can actually use it for non-medical related expenses. So before age 65, you pay a 10% penalty if you use it for something non-medical related. But after age 65, that penalty goes away. But you will pay ordinary income tax on the amount that you use on non-medical related expenses. So medical related, no tax at all, no penalty. Non-medical related, if it's before 65, you're going to pay tax and a penalty. If it's after age 65, there's no penalty, but you pay tax.
So you're telling me for tax deferred money, I can save to my IRA, I can save to my 401k, and I can save to the health savings account and not give Uncle Sam extra taxes?
That's exactly right. This is one of the buckets we love to tell people to save to if they're eligible, because it's a great deal of money that you can save to it without ever having to pay tax on it if you use it for medical.
Absolutely love it. See, who thought talking about healthcare and insurance would be so fun and educational?
Certainly not me, but you made it fun.
Well, let me tell you about the last few insurances, because there are so many that Lockheed Martin employees have that many of them are portable, which means you can take them with you when you leave or when you retire. Okay. First and foremost, everybody has a group term life policy, but you can buy additional amounts in that. And there's a group universal life policy, which is really great. So if you have that and maybe you do have a health issue and you can't get another life insurance policy outside, well, the good thing is you take it with you. You don't even have to answer any medical questions. So that makes it wonderful. There's special accident insurance.
Mm-hmm.
You know, a lot of employees travel to go see the different sites as they build the planes. Heck, we have Lockheed clients in Korea and Poland and Italy. So we know they're all over the place. You can have your family members also have life insurance. And then, of course, the supplemental medical, long-term disability, very important. I mean, if something happens and you get hit by a car, and goodness gracious, I've experienced that, and you have to be out for disability, it'll help cover your pay. And then the long-term care. Now, if you were one of the few that put long-term care in place as a group benefit way back when, and you still have it, kudos to you. one of the hardest, well, very expensive item to have these days, very beneficial because long-term care actually pays for home health care, assisted living, nursing home, all those things that a lot of our parents are having to face or grandparents are having to face. So,
Yeah, this is a great benefit. So being able to take these insurances with you, often this is overlooked. So if you're retiring or leaving Lockheed, you might take a look at this to see what you can take with you, because often it's beneficial for you.
yep. Well, Josh, some people make mistakes when they go to retire. Shall we share with them the top 10 retirement
Let's do
mistakes?
it.
Okay.
Drum roll, please.
Okay. Mistake number 1, not taking advantage of the full 401k match of 50% of the 8%.
Yeah, that's a no-brainer, Kelly. That's free money. And, depending on your budget, if you can afford it, that's a great place to start your savings. And then as you can save more money, obviously you want to try to save up to the maximum, which again, Lockheed has that higher maximum. So
Yes. And number 2 is not taking vacation first and then retiring.
yeah, so taking your vacation payout. This is for a lot of employers. And then retiring ensures that you get paid out on your vacation.
Yeah. And it helps you transition. If you're not used to, if you're working 40, 50-hour weeks and you're going to go down to nothing, it can be a nice transition as well. Number 3, not using the pension max strategy.
Yeah, again, this is a great great tool to help you to get more out of your pension. And when it works very well. And I think anybody that has a pension, they should be looking at this to see if they are eligible to do this. And if they are, it's a great idea.
Number 4, not using post-tax portions of your 401k to save more money.
Yeah, so we talked about this earlier, is Lockheed's unique in that you can save a whole lot more money to your 401k than most other companies. And so the advantage of that is that you go up to the IRS limit, you can do pre-tax, and after that, everything else is post-tax money that you're saving. And that, remember, that post-tax money can go into a Roth IRA once you retire.
And then number 5, not rolling your post-tax portion of your 401k over into a Roth IRA.
You got to remember to do this, folks. So nobody's going to tell you to do it. You got to remember to do it. So you get those 2 checks. Remember, the post-tax goes into a Roth IRA.
We'll tell them. Not naming a beneficiary on your 401k.
Lots of headaches when you don't do this, folks. So make sure you have your beneficiary on file.
Number 7, not taking advantage of the net unrealized appreciation for your Lockheed stock.
Absolutely. Can save you thousands of dollars in taxes.
Number 8, not utilizing the Lockheed healthcare and Medicare benefits.
Surprisingly, Kelly, a lot of people aren't even aware of this. So when we talk to people about this, it's as if it's not communicated. So you need to find out if you are eligible for this. And if you are, seriously take a look at it for your retirement benefits.
Number 10, not utilizing the Lockheed Guaranteed Universal Life Insurance that is portable.
Yes, and that is a great tool for looking at how you can have life insurance even in retirement.
And then your bonus mistake, guys, is not using me and Josh to plan your retirement.
That's right.
So
Yeah.
sad.
Absolutely.
So, as we wrap this up, let me tell you what the next steps are. So for anybody who is getting ready to retire, the very first thing you need to do is you really do need to gather your own information, right? You need to start writing down what your objectives are for retirement. What do you want the rest of your life to look like? Write down questions based on what you've learned in this class today, and then take action. Just by sitting here listening isn't going to make your position any better. You need to do something. So that is requesting a complimentary consultation to start your retirement planning and seeing if the pension max strategy will work for you. Josh?
Yeah, folks, what we offer is comprehensive financial planning, retirement planning, tax planning, estate planning. We are certified financial planners. We charge a flat fee. We are an investment management firm, so no proprietary products and no affiliations, no conflicts of interest. We do institutional style investing. Flat percentage charged on the asset levels that we manage for you. We also have an independent insurance agency, so we can help you with the Pension Max life insurance strategy. We offer long-term care insurance as well. You're welcome to request a meeting, and if you'd like, we actually have, if you'll go to the next slide, Kelly, we have an offer for you. Go to the, yep. So we have two different reports that we are offering today, free of charge. The first is a 401k analysis report. So if you're contributing to your 401k, you want to see how you're doing, how you can improve. The benefits of this is that we will look at your existing portfolio, give you suggestions on how to improve it. We'll take a look at the risk of your portfolio. So we have risk software that we plug all this information into, and it comes back with a risk score to tell you how you're invested. And then we'll give you personal recommendations on how you can invest to maximize your growth over time. We value this at $500. We offer that today for free. So if you'd like to get a 401k analysis today, the offer expires at 5 p.m. There's a QR code in just a moment that I'll show you for how you take advantage of that. For those of you that are more interested in the pension maximization analysis, we're also offering a complimentary report today. This is to determine if the strategy is right for you. We will determine the amount and the cost of insurance needed, and then we'll put in place a plan to get you the most out of your pension. So again, this is a report valued at $500. This is a complimentary report for you, but it expires today at 5 p.m. So how can you take advantage of that? Well, you can simply either use these two QR codes or go to that website and schedule a complimentary meeting with us. And on that call, it'll be a Zoom call. So it'll be just over the phone at your discretion over a Zoom meeting with you. And we'll just ask you some questions. We'll gather up some really basic information, and then we'll go to work and prepare your report, and then we'll provide that information to you. So if you'd like to partake in that, simply just click on the QR code with your phone, or just go to that website and schedule your meeting.
Of course, if you want to talk about anything else, you're welcome to come in person and talk to us about that too. We're not limiting you.
Absolutely.
But
Now,
we do know what we're talking about.
Kelly, you know what? When I handed over the controls, the chat feature, I noticed the chat feature is turned off. So if you have questions, we're going to take questions now, but we got to turn the chat feature on first, and you as the host have to turn it on. So I'm going to tell you how to do that. If you go to the chat feature,
yep,
and there's a drop down arrow, you just click on that, and it should give you the option to turn the chat feature on for the participants. Do you see that?
It doesn't. Yes, I believe it's on.
So if you want to type, yep, and there we go. We just got a test. So if you want to type your question into the chat, we're going to stick around for a few minutes to answer any questions that you have. We'd love to have whatever questions that you'd like to ask us. And in the meantime, I'll talk about some of the other services that we provide to our clients. We do comprehensive financial planning, and that means that we look at many areas of your financial situation. So we're looking at your current position and creating financials for you, a net worth, cash flow statement, looking at your budget and how you spend your cash. We look at all your protection needs. So this is looking at all of your different insurances, so auto, home, life, disability, long-term care, and looking for gaps, providing recommendations for you there. We're looking at all of your accumulation goals. So if you're saving for a specific purpose, like an education for a child or grandchild, we can help you to set up funds for that. We have a lot of pilots that like to purchase planes from Lockheed. And so we save for planes and help them analyze that. We also focus on tax strategies. So we're looking for ways to reduce taxes on your income and on your investments. And then retirement is the major focus for a lot of our clients. So we're helping you to determine how much money you need to have saved, what type of lifestyle that you want to live, and then what age you can retire at, and then looking at different options for how to improve that if you'd like to retire early. And then lastly, we look at estate planning. So this is making sure that you have all the key documents in place, so in the event of your death or incapacitation, that you and your family are taken care of. Those are what we call the 6 key areas, and that's what we address when we do comprehensive financial planning. Go ahead and type in a question, somebody, just to test to make sure. I think this is working. Yep, there we go. Here we go. Here's the question. Can you go back to the insurance after retirement on Medicare? What does LM provide?
Hold on, find the slide.
Past that.
Where is it?
Right
Oh,
there.
we go.
Yep.
Yeah, so what does the LM provide? Through VIA benefits, you have these supplemental policies that you can purchase that will cover the cost of care that Medicare does not cover. So they have a shopping area that they can help you with. As for the stipend, that will depend on your eligibility. It can be anywhere from $600 to $1,000 for you and your spouse.
Yeah, again, folks, this is a great benefit. For whatever reason, some people aren't aware of it. So I would definitely check with your HR department to see if you're eligible for it. But it's a subsidy that helps reduce the cost of your insurance. And so, especially for people who are retiring before the age of 65, you can get on the Lockheed plan. And then once you convert to Medicare at age 65, they provide a subsidy for your supplemental plan for Medicare. So great benefit, just gotta take advantage of it. So
right. Great question. What other questions are out there? Don't be shy. It's okay. Somebody else has already asked the question more than likely.
while we wait, I'll comment a little bit about what we've experienced with Lockheed retirement over the years. Lockheed has obviously changed their benefits substantially over the years. And there's been that shift of focus from pension to 401ks. And so I would tell you that, why don't you go to the last slide so they can get to the QR code there. There you go. So for a lot of people who don't have that pension, that means you're relying on yourself to save for your retirement. Pensions made retirement planning much easier, but if you don't have that pension, that's where that 401k is going to come in very handy for you. So that's one of the unique benefits of Lockheed is not only do they provide a great match, but they provide the ability to save a large amount to your 401k, more than most companies. So definitely take a look at that if you're kind of in that catch-up phase where you're trying to save as much as possible for retirement. We see that often when the kids get off the payroll, is that you can start saving more money. So they're looking for buckets to save too, and that's a great place to do it.
We even had former Lockheed employee on our staff too.
We absolutely do. Yeah, we do a lot of things with Lockheed. The other thing I'll comment too on, and you brought this up earlier, Kelly, is the long-term care. Lockheed had a long-term care policy for many years, and then they did away with it a few years ago. And that was just a great benefit. I mean, just a great benefit. And one of your biggest costs in retirement will be long-term care. And so if you haven't started looking at that yet, one of the main problems we see with long-term care is people wait too long to get it. Long-term care insurance is what I'm talking about. So, if you have a concern about that, if you have especially people in your family history that have used long-term care, maybe they have dementia, something like that, definitely better to look at that earlier rather than later. And in doing so, putting that in place for yourself.
Hey, and Jeff, to answer your question, we do work with clients who are not in the Fort Worth area. Because we have internet capability, we can work with clients wherever. We schedule early morning meetings for our people in Korea, mid-afternoon for our people in Poland. So it just depends. Wherever you are, we can make it work.
Yeah, we're not limited in terms of where we provide services. So we can service you no matter what. Due to the power of Zoom, we can be anywhere. So
and Daniel, your question of is it paid to Medicare? I'm assuming the stipend, even if you're already retired. But working. No, Lockheed pays that stipend directly to you. And the key is you had to get your supplement through VIA benefits. So you can probably still go back and talk to them, change your open season comes up soon. So you can look at that and see what you can do. Lisa, do you know anything about using a Medicare Advantage plan versus traditional Medicare? So Medicare Advantage plan is taking the government part A and B and the supplement and putting it in one. It's like having another HMO plan again, where you have to get your approvals. You have your primary care provider. Some people like that because it's an all-in-one package, and some people like to piece it together. There can be different costs. You need to check to see if your doctors take those plans or not.
One thing I'll comment on that, Lisa, too, is that one of the complaints about Medicare Advantage is once you get on it, if you change your mind, it's very difficult to switch to the traditional Medicare plans. So when you make that initial decision, you want to make sure you do your research and make a good decision, because it's pretty challenging to make a change, I've heard.
And guys, we have people on our team that we refer our clients to have these in-depth shopping discussions for Medicare. We have those insurance professionals, and that way you're not trying to do all the research on your own. I absolutely love them. When my son got off our TRICARE insurance, I had them shop to see what's good for them, and they said still use TRICARE Young Adult. It's the best. They've told our clients, stay on your California teachers plan. It's the best. So they're not people who are going to just sell you something. They're going to make sure that you have the right care.
Yeah, and one other comment on that, they often recommend the Lockheed plan over getting outside coverage.
Yeah, because it's a good plan.
It's a good plan.
Jeff, your question after the pension went away, was there a place where Lockheed contributes something additional to the 401k or somewhere else? Yes. That's that extra 6% that goes into the salaried savings plan. And that's 6% for everybody.
Great benefit for sure.
Welcome.
Well, folks, we're at 1 o'clock. So
I know everybody's probably hungry and they need to
Yeah.
go eat. But if they do have more questions, they should still email us though.
Absolutely, or schedule your meeting, and we're happy to answer your questions on that call. Other than that, we thank you so much for your time. We thank you for taking the time to meet with us today. We're going to send you the recorded version of this presentation, so you'll have it, and you're welcome to share it with whomever you like. We'll be doing more of these in the future, so if you'd like to join us for future webinars, we'd love to have you. Have a great weekend, and thank you so much.
Bye, guys.